Good morning, everyone. And today is the 12th of July. We've had a very quiet week with very little data. All we had was weekly claims. And the situation on the employment front is very much still the same. There are no hirings, but no one is getting fired either. Everyone at these companies must be waiting for Trump and the final deals that will come along from tariffs before deciding what to do next. So the economy at the moment is in a state of limbo. And you can tell that by the price action. We've been saying for a while that it's not really stocks going up. It's more the dollar going down. And therefore, as the denominator comes down, then stocks can go up slightly less than the dollar is devaluing. So if you look at where the S&P is for the year and you subtract the devaluation of the dollar against various currencies, you actually come to a pretty neutral zero or even small negative return for stocks for the year. So we're not really going anywhere. And the reason why we're not going anywhere, at least in my opinion, is because duration keeps on getting sold. We had the auctions for 3s, 10s, and 30s last week, and whoever bought the 10s and 30s is deep underwater today, as of close of Friday. And I think that trend continues simply because real rates are not high enough for us to want to argue with duration being sold.
Yeah, the bond market globally has been suffering, and policymakers have started to take steps on it. The Japanese bond market sold off heavily, and the BOJ decided to slow its taper of QT, of its balance sheet buying of QE, and they decided to reduce its supply of long-term bonds. And we got a brief bounce, pretty rapid bounce, but a brief bounce. And now we're going back toward the levels where that panic happened. The UK saw its long-term bond yields rise during the year so far and reacted in the last month or two by changing the composition of the QT, of BOE's QT, and the Office of Debt Management decided to reduce the amount of long-term gilts that they issue. So the government is noticing the poor performance of long-term bonds and trying to reduce supply of long-term bonds, and it's not working. And very recently, a couple of weeks ago, said he wanted to not issue any long-term bonds. That was an exaggeration, not atypical, but Secretary Bessent and the TBAC, which is the Treasury Bond Advisory Committee, which announces every 3 months what the new issuance of bonds is going to look like, have consistently said that they do not intend to issue more coupon bonds at each auction, despite the deficit continuing to rise. And now tariffs are helping that issue a little bit. Idea is that policymakers are willing to issue more short-term paper, bills to finance their government, do less QT or more QE in the case of Japan, in order to support the long-term bond market. And that's principally put pressure on the currencies. And so all the currencies are down versus gold, versus Bitcoin, versus inflation, the consumer, over the last few years. So the currencies have really taken the brunt of this, and bond yields have stayed in this range. But it continues to not really work. And efforts to manipulate the long end of the bond market just haven't worked. And as we've been very bearish duration for most of all of the time we've been in business. And we continue to be, because there's just no reason to own bonds if the only potential benefit for owning bonds is manipulative reduced supply. And so we come into this month with the Trump administration aggressively calling for Chairman Powell's resignation and now threatening investigation into the $600 million, less than a quarter of what the government spends every day on the military, overages in the renovation, the 10-year renovation of the Federal Reserve building, as a sign that Powell should be fired for cause. So lots of nonsense. And if Powell were to resign or he were to get fired, that would have major consequences. So we're paying attention to that, and we're paying attention to the QRA on July 30th, where we'll find out if Trump and Bessent will join the BOE, Office of Debt Management, BOJ, and MOF in trying to manipulate the long end. But buying bonds isn't the play if they do.
Correct.
Buying gold, Bitcoin, stocks will be the play if the U.S. government joins the rest of the world in manipulating the long end of the bond market and destroying the independence of the Fed. So what do we think happens to bonds?
First of all, let's try and put some odds on these things happening.
Sure.
I think the combined odds of Powell resigning and or the QRA being changed from the current levels, combined together, they're probably single figures to low double figures, 5-15%. And I wouldn't give more than 5 to 7% odds of either happening. I think that Powell will not resign because he is an institutionalist and he cares very deeply about the Fed's independence, and he feels that if he were to resign, he would be handing on a platter to Trump the Fed's independent role. So I think that is less likely than QRA being changed. QRA being changed is something that Bessent can do by himself, whether he has the support of TBAC or not. He could use TBAC as some kind of a fig leaf. He's shown himself to be very much a Trump ally, and so he could do the political thing and change the composition of the QRA. If any of those things happened, I think that the long bond would definitely spike the previous highs, which are around 5.11, and would very quickly go to something like 5.25. The yield curve would go very much steep. The short end would very much rally, and that's where we are positioned. What would we do in that scenario is really sell the short end that we own, because there's no more point in owning it. It would have reached the levels that the market will discount the levels that they think the new Fed chair or whatever is or wants to achieve, and therefore we would just dump all our bonds, all our short-dated bonds into that rally, and we'd have to seriously consider buying gold, as you say, Bitcoin, commodities, and also equities. The interesting thing about equities is that we are having the tariff impact starting probably next week in the CPI data and the PPI data. There are many houses, JPM being the most vocal, who see core CPI actually rising towards 3% by year end. And therefore, real rates, rather nominal rates where they are now, translated into real rates, are not really that high, because nominal bonds could easily go to 5.25 or even 5.5%, and real rates not achieve a level which we think is a screaming buy. And that is quite possible.
Right. Let me come back to the idea that we were talking about, which is this 5 to 15% odds of something in which the Trump administration heavily manipulates the bond market. Nick said long-term bonds would spike. I'm not sure I agree with that. I think what is definitely true is short-term bond yields would fall rapidly, expecting more rapid cuts once Powell
I
resigns.
was only referring to Powell resigning rather than
Okay.
changing the QRA.
Okay, that's fair. I'm still not sure because the pressure on the front end would be extensive. So what I'm thinking about in terms of the long end is what would happen if in the 85 to 95% case, which is Powell's still around through his term, a dove is put in to replace him in May of next year, and short-term interest rates thus probably get cut later in 2026, more than expected. And the QRA stays lots of coupons being issued. That's where I think you have the long end also selling off. And in that circumstance, you ask yourself, there's got to be a price where you want to own bonds. And we're going to have a price. I think it's when real yields break their highs. And at that point, we're going to want to own bonds. But why own bonds? You still have, in terms of making money in bonds, you can either just own them for life, which is at real yields high. That's a good reason to do it. But you're not likely to see significant capital appreciation in the next year or two unless the economy weakens. And if the economy doesn't weaken, stocks are going to do okay. So I think the important direction we are heading is, hey, if the 5 to 15% chance happens, you got to own gold, stocks, and initially, you got, for the next year probably, you got to own gold, stocks, Bitcoin, and you can't own any bonds. In the 85 to 95% case, you still can't own any bonds, but there's going to be a price where you absolutely can own bonds.
And will be the price where you buy stocks as well.
Exactly.
Because when real rates get high enough, that is probably the bottom for stocks and for all assets. You're talking
for all assets, that's the important bit. Not just stocks may not be anywhere near their bottom.
The best time to own assets is when real rates are topping. And if we get the real rates level at which they will top, that is the best time to actually load up leveraged on every single asset out there. Probably apart from gold.
That's the direction we're heading. I think the next week is going to be interesting. More Powell threats. Powell's already responded to this crazy thing about the renovation of the Fed building. We've got Trump saying next week that he's going to make a major announcement on Russia. There's speculation on that being related to oil, which could spike oil prices. We have the CPI and PPI data, which should start seeing some creeping in of this tariff revenue. And then we have earnings, which start for the next couple of weeks. So there's going to be plenty of noise around the markets. But given the weakness in long-term bond yields and the relative equities are up a bit, but not great returns so far this year, there's no reason to chase assets in the next few weeks. Let the news come out, maybe opportunistically take advantage of that during the next few weeks. But the big portfolio shifts will happen in early August. And that will be, we'll have certainty around the 5 to 15% low case odds, or we'll likely have a point where real yields spike. And that will be a good entry into using some of our low risk assets, short-term interest rate exposures, cash, et cetera, to lever up our portfolio.
Completely agree with you, Andy. Great. Thank you very much indeed, and speak to you next week.